This is Vox Crest Report. I'm Daniel. Tonight, global markets are bracing for volatility as traders prepare for the next sessions after a fresh tariff shock tied to the Greenland dispute. Reports say President Donald Trump is pushing a new tariff plan aimed at multiple European countries, with a start date of February 1st and a possible escalation later in the year. Even before anything takes effect, markets often react to uncertainty first, because tariffs change costs, supply chains, and earnings forecasts fast. That uncertainty is why traders are preparing for sharper swings when markets reopen. In these moments, stocks can gap lower or higher at the open as funds reprice risk all at once. You also often see a rotation into safe havens. Gold tends to draw demand when investors move into risk-off mode. At the same time, volatility hedges become more expensive as traders buy protection against big market moves. Tariff news can also hit currencies and government bonds. If investors expect slower growth or higher uncertainty, money can flow toward bonds and push yields lower. Currencies can swing as traders reassess which economies could be hit harder by trade disruption. One reason this story matters is retaliation risk. Markets usually fear the second step more than the first. If Europe responds with countermeasures, it can turn into a cycle of escalation that makes global growth harder to predict. So who is most sensitive if volatility jumps? Usually it is companies that rely on cross-border trade and complex supply chains. That can include large exporters and multinationals, industrial firms, and sectors tied to shipping and logistics. Banks can also move sharply if growth fears change interest rate expectations. Here is what to watch next. Any official confirmation of tariff timelines and legal details. Signals from Europe about countermeasures. And the market stress indicators, especially gold and volatility gauges, which often react fastest. You're listening to Vox Crest Report. Subscribe for fast updates and I'll see you in the next report.